Hello and welcome to Yadnya Investment Academy. Today we are going to discuss what is current account deficit, that is CAD. Current account measures the flow of goods, services and investments into and out of the country. We run into a deficit if the value of goods and services we import exceeds the value of those we export. Now, before understanding the current account deficit in detail, let's understand what are the current account transactions. Current account transactions are the transactions which require foreign currency to execute. For example, payments connected with foreign trade, that is import and export, which is the biggest component of current account. Interest on loans given to other countries or taken from other countries is also part of current account transactions. Net income from investments in other countries, remittances for living expenses of parents, spouse and children residing abroad also comes under current account transactions as it involves foreign currency. And even expenses in connection with foreign travel, foreign education and medical care of parents, spouse and children comes under current account transactions. Now let's understand how this current account deficit is calculated with an example. So suppose total value of goods and services coming into the country includes, for example, imports at $1,000,000,000, expenses in connection with foreign travel, education, health done by citizens is suppose $200,000,000, interest and dividends paid to other countries is suppose $150,000,000 and other outflows is suppose $100,000,000. So total value of goods and services coming into the country is $1,450,000,000, that is $1.45 billion. Now let's take the example where we calculate the total value of goods and services going out of the country. So export suppose is $900,000,000. Income from foreigners traveling to our country, education, health, etc. is suppose $150,000,000. Interest and dividends earned on the investments done in other countries is suppose $200,000,000 and other inflows which may include remittances is suppose $150,000,000. So total value of goods and services going out of the country is suppose $1.4 billion. So in this case, current account deficit will be total value of goods and services coming into the country minus total value of goods and services going out of the country, which comes at $50,000,000. So we can say that current account deficit occurs when the value of goods and services coming into the country exceeds the value of goods and services going out of the country. So now we will understand the difference between current account deficit and trade deficit. Now, trade deficit is an economic measure of a negative balance of trade in which country's imports exceeds its exports. A trade deficit represents an outflow of domestic currency to foreign markets. Now, trade deficit actually is a subset of current account deficit. Trade deficit only measures the difference in exports and imports and does not consider other transfers or interest or dividends. So in the example above, trade deficit is simply imports minus exports, which is $100,000,000. So trade deficit will be $100,000,000 and current account deficit is actually $50,000,000. Now, how is this current account deficit financed? Current account deficit can be financed by capital account or financial account. Now, government buys and sells foreign currency, so may give loan to other countries or may take small short-term loan from other countries. That may change the value of current account, and this type of financing is done via financial account of the government. Another more popular and more important way of financing current account deficit is through capital account transactions. Now these are the major capital account transactions. First is FDI. Now this is the best way to fund current account deficit as this is a long-term money which comes into the country. Second is foreign indirect investments in the equity markets or debt markets of a country. Now these are called hot money and they can go out of the country very quickly. So therefore it cannot be dependent on for long term. Third are remittances which come as investments in India. Investments can be in real estate or in other financial assets. This graph shows how India's current account deficit to GDP ratio has been in last 10 years. And we see there have been a marked improvement since 2012, but in last 2 years it has again started increasing. Now India's current account deficit is actually expected to widen to 2.5% of GDP in this financial year, that is 2018-19, says experts. It was 1.9% of total GDP in last financial year. Major reason for this dip in current account deficit is decreasing oil prices in these years, and India's currency was strengthening, which was further reducing our import bill. India is largely dependent on oil imports for its energy needs, and that is the biggest component of our total imports and also the biggest component of current account deficit. Now in last few months oil prices have started increasing again, and also India's currency has started depreciating, which is even increasing the price of imports more, and hence our current account deficit has started increasing again. Global trade wars started by United States is impacting our exports as well, and is also depreciating our currency more, which is impacting our current account deficit. Also, US Fed is increasing its interest rate, and therefore one of the component of current account deficit financing, that is foreign indirect investment, is reducing in India. So all these factors are impacting our current account deficit as of now. Even though a current account deficit of 2.5% of India's GDP is not considered very high, but it can increase even more if the current challenges continue. So challenge before the government currently is to devise policies that will boost exports and reduce unnecessary imports even more, such as gold. Now question comes, is current account deficit always bad? No, it is not always bad. Big emerging economies and developed economies mostly has current account deficit, and mostly small developing countries have current account surplus. Like in case of India, small current account deficit may not be a bad, as it shows it is highly dependent on India's fuel imports, and fuel imports are increasing because India's hunger for more energy is increasing as we are developing. So that is all we have on this topic of current account deficit. If you have any question on this, please do write in the comment section below, and do not forget to subscribe to our channel for more such videos. Have a great time ahead. Jai Hind.